Hi, welcome back to All Things Money. This is John Gjertsen, and I'm talking today about 529 plans. As we discussed in the last segment, a 529 plan is a little bit like a Roth IRA in how it behaves with tax. So you put money in to save for college, either for your son or your daughter or your grandson, granddaughter, that kind of thing is normally how it operates. And that money is, in some sense, still your asset. It's something that you still have the ability, you as the custodian of that, have the ability to control how that's invested. You have the ability to change the beneficiary to a brother or a sister or even a cousin or a spouse. There's lots of, this is all, and by the way, you want to do some background research on 529 plans, look up Publication 970 by the IRS. It deals with all kinds of college education related topics, and these are called qualified tuition plans, or QTPs, but everyone knows them as 529 plans. So the parent or whoever set up the 529 plan still has control of that asset. However, for estate tax purposes, it is not the parent's asset. So that's kind of an interesting nuance we'll get into in the next segment. So they set up the 529 plan and then direct how it's invested, given a sort of limited set of investment options offered by the plan administrator, which is run by one of the 50 states, and then that money can then be used for college. And recently that's actually opened up, and that money can be used for computer expenses and some other things, but it is for college, or it is for something that is post-high school, let's put it that way. I don't know how the IRS code writes it, but this is not, just to be clear, something that can be used to fund private schooling before college. If you need some tax-advantaged way to do that, there is something called a Coverdell ESA, Education Spending Savings Account, something, Coverdell ESA. That has a lot more restrictions on as far as who can contribute and how much you can contribute. You can only put in $2,000 a year into a Coverdell. For that reason, they're not as effective a tool, but they do have the flexibility of being able to fund expenses for private schooling prior to college. Anyway, back to the 529 plans. These are really college savings tools. And the thing that, I guess the reason why they're often referred to as the best tool around for college savings is really because the other tools are not so good. So like the Coverdell has such a low contribution limit. Sally Mae runs something called U-Promise. A lot of people link a credit card and they go grocery shopping and they get 14 cents or something back, and that's really not a way to actually save any real legitimate amount of money for college. So the 529 plans are generally the best tool around for saving for college, simply because that savings that takes place, it's tax-free. It's once it's in the plan, the savings, the investments, you don't pay any tax on them. Once you take it out for college funding, you don't pay any tax on that. So that's good. And then some of the plans, I mentioned it's not important what state plan you use, and that is not necessarily the case, not necessarily true. In North Carolina, for instance, we have a state tax deduction on making a contribution into the plan, $2,500 per taxpayer, or a married couple would be able to double that and have a $5,000 tax deduction, not on the 1040, but on like our North Carolina state tax return. So it's not as valuable as having a federal tax deduction, but it is nonetheless a tax deduction. And let me point out that this is a rare instance where you get a tax deduction going into this kind of a plan. It's tax-free while it's in the plan, and then taking it out to pay for education, it's tax-free on the back end. So it's just rare in the tax world that you have that kind of a thing. The other example of that kind of a thing would be a health savings account, where you get a deduction putting money into an HSA, tax-free while it's in the HSA, tax-free coming out of the HSA. It may not sound like a big deal, but that's kind of that's the trifecta of a really tax efficient vehicle. So this is not, unlike the HSA, this is not federally tax deductible, but certain states have, as an incentive for their own residents to participate in their plan, set up their HSA in such a way they give a tax deduction or a tax credit on the state return to a participant. So North Carolina is one. We have a state income tax and we have a state tax deduction for participating in our own 529 plan. Some of the things that I don't particularly like and want to just caveat all of the listeners, all the viewers about 529 plans, I'm not so thrilled about these that I recommend them, for instance, to most of our clients. And one reason is that the biggest factor is that most people are not actually saving for retirement as much as they need to be. So I don't want, like college funding is really a speed bump in terms of the size, the magnitude of a financial goal compared with the enormous goal of becoming self-sufficient post-work in retirement. Most people have not made preparations, so I don't want people to be sort of stealing from what they need to be doing on their retirement goal to try and do a college funding goal, when in fact if they don't prepare for college funding, then they could easily have their kid qualify for some sort of financial aid. I say easily, but that sort of thing happens, and whereas if you don't prepare for retirement adequately, then you know the only safety net you have there is Medicaid, and that's not a safety net that I'm going to recommend to you. I'll get into a few more things that I don't like about 529s in the last segment.